Hello and welcome to the Views from the Lake. I'm your host Alex Chalekian of Lake Avenue Financial. Today I wanted to take a couple of minutes to discuss something that we have recently started to talk about with our clients, and that is the 5 reasons to get out of the stock market now. Let's jump right in. In no particular order, number 1 is the US dollar. The dollar will go higher and pretty much wipe out any gains you might have in any investments held in other currencies. Now the dollar versus euro has rallied over 27% in the last 12 months. These types of moves are not normal. Now as an American that likes a vacation in Europe, I'm excited. But as an investor, I'm worried. Ultimately, a higher dollar means lower earnings for the multinational corporations. The currency exchange has been hurting global companies, and we don't think the rally in the dollar is going to stop anytime soon. Wall Street will eventually wake up and realize that companies are just beating estimates that have been revised downward over and over again. Now, Barron's pointed out recently that earnings growth for the S&P 500 is well below its 30-year average, and dividend yields are well below their 20-year average. Number 2 are the U.S. markets that are currently at an all-time high. We have seen the Dow pass 18,000, the NASDAQ pass 5,000 again after 15 years. The Russell 2000 hit an all-time high, and the S&P 500 index is currently sitting at 2,100 at an all-time high. So this might not be a bad time to lock in your gains. We all know that market timing is extremely difficult, and none of us have a crystal ball. But remember, you not to be greedy and lock in your profits or put some measures to protect you on the downside. Always keep in mind that the name of the game is to buy low and sell high. And guess what? We're at the high right now. Number 3 is diversification. So what does the Dow Jones Industrial Average, the NASDAQ Composite Index, and the S&P 500 have in common? Give up? Well, all 3 major indexes now include Apple as part of their allocations. So if you're the average investor and you own a combination of any of these major ETFs, like the SPDR S&P 500 ETF, the SPDR Dow Jones Industrial Average ETF, the PowerShares QQQ ETF, or index funds like the Vanguard 500 Index Fund, you are not diversified as you think you are. I recommend you take a closer look at your current portfolio and run a true analysis of your holdings to see how you're positioned. I think you'll be surprised to see that most of your holdings own a lot of the same stocks. Now, number 4 is the Federal Reserve. It's no secret that the Fed has its back against the wall. The markets are hanging on every word that comes out of the Federal Reserve Board Chair Janet Yellen's mouth. Will they use the word patient or won't they? The current economy, according to the Fed, is doing well, but not too well. Unemployment is at a level they are comfortable with, and GDP is humming along. But what if things get too good? They're not scared to do what the markets fear the most, raise rates. Well, I'm here to tell you that it's coming. I couldn't tell you if the Fed will raise the rates in June or at the next meeting after that, but it's going to happen sometime this year. And when that happens, the stock market and the bond markets are not going to like it. Number 5 is the weakness in the international markets. As Mario Draghi of the European Central Bank tries to save one country, another country gets into trouble. Think of it as a dam that has a bunch of leaks. Mario keeps trying to plug the leaks with his fingers, and then another one springs up. He only has so many fingers. Eventually that dam is going to burst. We see talks in Europe breaking down. Now China has also been a concern. Their economy has been cooling down and hasn't been the driving force that many economists expected. To sum it up, these 5 reasons are why you need to get out of the markets or put some safety measures to protect you on the downside, especially for those of you that are either currently retired or about to retire in the next couple of years. I urge you to lock in your profits and utilize different instruments to help you reach your retirement goals. We're in a very volatile state in the markets, and at any time we can see the markets melt down like they did in 2008. You need to be ready and utilize active portfolio managers like ourselves that have a sell discipline built into our models. All of Wall Street has their finger on the sell button, ready to push it. Do you? Thank you for watching our video. We'd love to hear your comments. To watch some of our other videos and read our blog posts, please visit our website, lakeavfinancial.com. There you'll be able to subscribe to our weekly newsletter. You can also find us on Twitter, LinkedIn, and Facebook. And remember, here at Lake Avenue Financial, we manage your wealth with your goals in mind. Thank you for watching.